Mining Weekly Online is talking to David Brown, the CEO of CoAL of Africa Limited, which reports its financial results for the 12-month to June 30 today. David, can you give us the main points?
These results really, I think, reflect the success of the turnaround strategy that we started some 12 to 15 months ago. Obviously, we had to place a number of our operations on a care and maintenance basis. This obviously reduced an impact on revenue and obviously product produced. At the same time, though, you'll notice that cash expenses came down quite dramatically, really reflecting a new positioning for the company.
Did you narrow the loss situation?
We did. We certainly narrowed from a cash loss perspective. We went from about $68 million down to about $21 million.
Give us the repositioning.
We started off with a 5-point turnaround strategy. The first point really was to bring on a strategic investor into the company, someone who was in the coal industry, someone who understood the coal industry and would obviously help develop our long-term projects going forward. We were successful in enticing a Chinese company out of Beijing. They injected $100 million in the initial phase. That obviously helped to provide an element of financial stability in the previous 12 to 18 months. In addition, we obviously looked at the asset base and decided on which were core assets and which were non-core assets. The non-core assets we have then decided to dispose of. And in fact, we signed the sale and purchase agreement for the sale of Mooiplaats only a week or so ago, which then culminates in terms of that we've concluded the sale agreements for all the non-core assets that we originally identified. The third element was obviously reducing cash burn and at the same time also reducing overhead cost. We cut costs around about 30 to 40%. We've cut obviously staff quite considerably as well, and at the same time also stemmed the losses from those operations that were burning cash. Then the fourth element was to Vele had obviously shut for a period of time, reopened, proved to be unprofitable, in part because the product suite that we were producing was not optimal. We then spent some time in terms of doing additional drilling work and core sampling to ensure that we understood the quality. The quality was tested by both ArcelorMittal as well as by Eskom. Both found the quality acceptable for their needs, and obviously that gave us some comfort that we were able to produce a good quality product from Vele, and hence we began to put together a financial model which would enable us to reopen that colliery. And in fact, we are working in terms of a plant modification process, which is obviously part of the equity raises now. And the last element of the turnaround strategy was really around Makhado, was effectively trying to ensure that we could get the Black Economic Empowerment shareholders involved in the project, and then also looking at the funding for those Black Economic Empowerment shareholders as well. And we've been talking to a number of institutions with that regard.
And when do you think you'll reach some sort of fruition on the BEE side?
We are hoping that we would reach some kind of fruition by the end of this calendar year. That would then enable us obviously to finalise the funding, which we would look in terms of calendar year 2015. As you know, with Makhado, we're really trying to have a self-funded process, which effectively means selling project equity not only to the Black Economic Empowerment stake of 26%, but also looking to sell up to 23% of equity to a strategic investor, and that strategic investor, so we haven't identified, but we would start a roadshow next year in terms of calendar year 2015 to actually look for that strategic investor.
Just with regard to the capital raise and the share sale, is that coming through or has it come through yet?
The equity raise is divided into two stages. The first stage effectively is linked to regulatory approvals, and that would then, once those are satisfied, we would issue about 251 million shares, raising in the order of 21 odd million US dollars. And then the stage two effectively is the new investor that we've managed to entice into the company, TMM. They are looking at ensuring that they have sufficient liquidity in their funding process to ensure that they can then participate in the stage two, which would then be obviously the balance of shares issued. In terms of stage one, the regulatory approvals were effectively what they call FIRB, which is the Foreign Investment Review Board in Australia. As you know, CoAL of Africa is an ASX listed company, and essentially the second element of it is the People's Republic of China approvals. The FIRB approvals have been received, so those are done. The only outstanding regulatory condition as PRC, and we anticipate that in the next couple of weeks.
And tell us about the coal mining side of it.
The game changer for Coal of Africa really is the access we have to the hard coking coal resources. As you know, the hard coking coal is much rarer than the thermal product, and as a consequence of that, it's used in the steel industry, and it also manages to command a price premium over thermal coal as well. So again, I think from a coal perspective, that's going to put us in good stead for the future. In terms of resources, we have access to about 8 billion tons, gross tons in situ, so a considerable resource, and a high percentage of that is hard coking coal. In South Africa at the moment, there are not hard coking coal producers, and at the moment ArcelorMittal and other steel producers have to currently import all their requirements. So we see ourselves as probably having a twofold benefit. One is obviously providing jobs in the Limpopo, which is obviously an area of underdevelopment, and obviously savings on foreign resources and reserves for the country. Makhado would be just the first stage. I mean, there's obviously the Greater JOHANNESBURG projects which were acquired a few years ago from Rio Tinto. Those also have access to hard coking coal as well. We do have a large amount of unexploited resources, and I think that's been the issue with the company. We haven't had much in terms of the production profile, but we've got a lot of resource. So effectively the positioning for the company has been to put it into a position where we go from a operator at a loss to a project development, and then obviously an operator at a profit in the future. And that's really the evolution that we're going through now.
When do you expect to break into profit?
I would say probably around about 2017 is probably the year when we would be up and running at Vele, and certainly construction for Makhado hopefully will be underway as well, and we'll be able to register a group profit at that point in time.
That was Mining Weekly Online talking to David Brown, the CEO of Coal of Africa, which is listed in London on the AIM, in Australia on the ASX, and in Johannesburg on the JSE.